Hi everyone, welcome back to Be Rich. It's me, Vinod, here with Shashwat. We did do a live video a few days back, and then Shashwat had an idea of something he wanted to share with you. I said, Why not? Come to the studio. We await your presence and you share us the knowledge to hopefully make us better investors.
Yeah. So the topic today, which I wanted to talk about, is Howard Marks's memo. Not just any memo. This memo was his, not his most recent one, but I think the one before that. It's called Ruminating on Asset Allocation. So ruminating on asset allocation, meaning that when all of you ask questions, for example, in the live stream, we were asked, "Sir, should I park my money in FD, gold, bonds? Where should I put my money? How much should I put in it?" And then there are frequent questions about, I have 10,000 rupees salary. I don't know where to put my money. Should I put it all in stocks? What to do? So to answer this question, or rather to help you answer this question, I figured that this might be an interesting topic to bring up in the channel. Right. So maybe I can start off with what Mr. Marks has to say, and then maybe we can build off of that. So the first thing that Howard Marks talks about is that at the bottom line, there are only two ways in which you can truly invest. The first way is ownership, and the second way is credit. And by credit, he means you lending to someone. So he says that at the bottom line, these are only two ways. I might add a third way to this, which is underwriting, where you basically give a guarantee to someone that you will, vouch for them or something to that effect, for which you can get paid. But some might consider that a service and not an investment more so, because you're not putting out capital.
Yes.
So the only two ways in which you can put your capital is you can put it in credit or you can put it in ownership. Now, he says that there are some inherent risks involved in both of these two things. And he says that when we say that we want to do a 60-40 asset split and we want to do, like, let's say 20 in gold, 40 in stocks, 40 in bonds or something, he says all of this gives us the illusion that ownership and credit fall under the same wing. However, he says there are huge differences between these two avenues of investment. So the first distinction he draws is that ownership refers to your stocks, gold, whatnot, where you basically own the thing. It's you have a document which certifies that you own this asset, and owning that asset, if it's a stock, entitles you to some benefits such as dividends. You get voting rights, and if you own enough of the stock, you get to even pass decisions on the board. There are multiple other things that you can do. On the other hand, when you have credit, the only thing that you are entitled to mostly, unless it's convertible or something, is that you basically have a situation where you are guaranteed a rate of interest or something to that effect, where you are paid a fixed amount of money, which is why it's called fixed income. So the income is relatively fixed. Yes, it could go bankrupt at some point, that's true. But the point is that in general, this is a fixed income asset where you're holding it till maturity. That's what long-term investing is anyway. So now, given these two this distinction, he talks about risk, and he says that a lot of us treat risk as something where this is inherently risky, that is not risky, and there is a lot of risk in this, there's no risk in that. What he wants to tell you is that when you think about asset allocation, the first question you have to ask yourself is, how much risk do I want on my plate? So he says that depending on what your answer is to this question, and this question is answered not through some arbitrary number saying that I'm willing to risk 20,000 rupees, not like that. The thing is, he says, your risk tolerance is something which you have to decide beforehand in order for you to be able to allocate cash into ownership or fixed income. Because in ownership, you risk your entire capital, whereas fixed income, generally, you don't risk your entire capital. The window of outcomes is actually a bit narrower in fixed income. For example, government bonds are as good as safe because they're considered the risk-free rate of investment. Now, if you tell me that you've lent to Argentina, then I'm sorry, then there is a risk. But the point is, if you're lending to the US government or the Indian government, for example, the assumption is that the RBI will step in if things get nasty.
True.
So, given this, Howard Marks says that our editor Rupesh will now put a graphic on the screen where there's a bell-shaped curve where you can see. Those of you who've done statistics can immediately understand what's going on. And for those who aren't so familiar or in touch with it, let me explain what's going on. So the point is that the bell-shaped curve basically is a spread of outcomes that can happen. On the one end, you can be the other extreme and say that, for the amount of risk that you've taken in, the returns can be close to zero. And in this end, the returns can be like 200%, 300%, 400%, whatever number you want to put on it. Nvidia, for example, 1000% return. So the point is that the outcome is like very varied. Whereas if you look at fixed income, you see a very narrow bell-shaped curve where the outcomes are centered around a certain interest. So for example, the return on your investment is supposed to be 7% yield. That's pretty much what you can expect if everything goes correctly for you. Because you're buying it for 7%, you're holding it to maturity, and you get that 7%. So what Howard Marks says is, for example, if you are a retiree, you probably don't want to indulge so much in the stock market unless you aren't dependent on that money. You have a source of money separately, and this money is not something you need for survival. And your living, your food, your children's education, marriage, all of that can be taken care of without this money being there. Then you can invest in more risky stuff. But the point is, Howard Marks says, look at your situation. What kind of a situation do you have? How much can you risk? How much volatility can you handle? If a stock market goes into a bear market for 10 years, possible. It's happened before. If it goes into a bear market for a decade, will you be able to stomach that? Yes, it'll eventually recover, probably. But will you be able to stomach something like the lost decade in Japan? The bubble broke in 1989 and it didn't touch back to where it went during 1989 until 2020 something. So will you be able to hold on for 30 years without ever touching the peaks that you saw when you first invested? That's the kind of risk he's talking about. That's the extreme. But the point is, are you willing to risk that? If you aren't, then you should probably look at fixed income. Even something like gold is probably less risky in the long run compared to something like a very high growth stock. For example, if you're investing in the cutting edge technology, there's no guarantee that Nvidia is going to be the biggest firm tomorrow.
No.
And if you aren't willing to stomach that, yes, it's possible that Nvidia might jump leaps and bounds and do something crazy. But the point is, you don't have the risk appetite to be able to handle that. So Howard Marks says that you basically need to pick one lane of your risk strategy, stick to it, and then figure out how you want to allocate things. Don't allocate things because you think that wonderful, XYZ stock is at a very, throwaway price. Anand sir has said that this is something he's considering, so I'm going to purchase it. Don't do that, because the point is you need to figure out whether you can even hold it. Yes, a stock can be a value buy, but the point is it can go very badly before it goes better. Will you be able to stomach it? If for 10 years Tata Steel didn't perform, Tata Motors didn't perform, would you have been able to hold it? Would you have had the stomach to hold it? If you can't, then even if it's a value buy, that's not your risk profile. So just because something is bargain, you won't buy it. If there's a huge couch which is selling for a bargain price, if you're living in a studio apartment, you're not going to go buy that couch because you think that it's very valuable, right? So this is how Howard Marks looks at it. Now, the question I have for you is that given what Howard Marks has said, given what we've discussed, how would we balance value investing with this? That's what I'm thinking about.
Okay. There's two things to keep in mind.
Yeah.
One, this is very true, risk asset allocation. But one thing you also have to keep in is the current climate in the asset allocation. Yes, you may be liking to take a lot of stocks and you feel you can take on risk. But if we are right now peaking at a bull market, there's no choice but to stay heavily on the debt side and wait for the opportunities to come. Same way, when the opportunities do arise, you have to have the nerve to get back into equities and let go of debt and enter equity market. That, coupled with your runway and your financial situation, all put together, it's very difficult. Yes, it would be the ideal if you could pick a lane when it comes to risk and stay in it, but life doesn't allow you to stay in one lane for very long. Conditions of life keep changing erratically, so your risk profile also changes quite erratically, and your situation in life can push you to taking on more risk and or less risk, and may not even be your choice at that moment. Sometimes life can force you to take on additional risk because you just don't have a choice. You have to go for it, because the situation demands it. So that is something very important to keep in mind. And in terms of where should you be, in debt or in equity when it comes to a value investor, even Warren Buffett, one of the world's most famous value investors, is heavily in debt right now. He's holding a lot of treasury bills because he feels the market has gone crazy. He sold quite a bit of his Apple holdings. He sold a lot of holdings, and he's taken all that cash and he's bought US treasury bills, saying this is as good as a return I can expect in the stock market. Compounding, pretty happy he is, and he's sitting there waiting for a great opportunity to come if it does come. So completely depends on the situation. You can make a lot of plans, but all those plans go out the window when life happens, like Lenin said.
Yes. So one thing which Howard Marks says about that, he says, yes, once you pick a risk profile, then the situation arises, you get opportunities, you get something like a bank which has a lot of trouble, but you believe that the bank is still very underpriced compared to the trouble it has. The question is, should I enter it? Howard Marks says, maybe, maybe not. The point is, how willing are you to deviate from your risk profile? How much room do you have in your life to deviate from that risk profile? Are you young? Do you have earnings on which your parents are not dependent on? Do you have children to take care of? Are the school fees going to come next month? Are they going to be a year away? Can you pay it off in bulk today and not worry about it for the next year and a half? These are questions which you need to think about. And if after you think about these situations and you think of the worst case scenario that can happen, which is the law of inversion, which Charlie Munger talks about, you think about the worst case scenario that can happen. Will you be able to handle it? If you're going to be able to handle it, how are you going to be able to handle it? If you're able to think of these things and you still feel like, okay, I've thought about it very deeply and the point is that I can go for the shot, then go take the shot. But the point is that remember what you are able to handle and what you're not able to handle. The asset allocation of 60-40, 50, 50-50, all of this comes after the fact of you deciding how much risk you can take. So first you have to decide how much risk you take, and then you can figure out whether I should be 80-20, 80 in bonds, 20 in stocks, 60 in bonds, 40 in stocks. There's no set allocation for everyone, and you have the freedom to choose what your risk profile is and then pick according to that. And of course, like he said, no situation is perfect. You, when given the opportunity, can deviate. For example, Howard Marks, who is a slightly offensive investor, if I may say so, is talking about credit. In this memo right here, he says that US non-governmental credit is returning on average 10% for quite lower risk than stock market. And 10% is generally what the S&P has returned on average over the past few decades. And he tells us that if I can secure a 10% return with lesser risk, by all means, I should advise my clients to be able to do this and do this because that is the most optimal choice for them to go into. So if their clients are willing to, value less volatility and they're able to value the fact that they're getting a good deal on it and the risk profile fits it, he says, by all means, I'm advising them to do it. So the point is, we don't need a Howard Marks to come in and tell us what our risk profile is. We can think about it and we can figure out what it is and then come to an answer on what our allocation is. There are multiple examples of what we should do in the intelligent investor as well. He talks about the widower. He talks about a doctor, a surgeon who's very busy. There are multiple cases where he picks, and you can look at it and you can get a fair idea of what a good risk profile looks like compared to your context.
Yeah, and I agree. But that's why I like what my brother talks about different coffee range investing, because different coffee range investing exposes you to risk without feeling the risk. So let's say you want to be in equity market, buy different coffee range investing, where you're throwing only a little money, which you don't mind losing, into the market. Even if the markets are volatile, you don't feel it because it's a very small amount of money which you're putting out there. And compounding that over a long period of time can give spectacular returns. These ordinary stocks which you buy can give you those extraordinary results. And even his strategy when it comes to lump sum investing, where you put it into a debt bond, good corporate bond, and take that interest and continue doing different coffee. That way you hedge your bets against both sides, the risky side and the non-risky side. You straddle both and you can ride it. So even if you're not able to assess your risk, even if you're not able to wrap your head around all this, there are very simple ways to invest. Like what my brother says, Peter Lynch says, if you can't get your head around what Shashwat is talking about.
Yeah. So that being said, the main outcome of this is for people to understand that before you start talking about numbers, try to figure out what your situation is and figure out what your context is and what you will be able to tolerate. Because even tiffin coffee might be too risky for a lot of you. So you guys have to decide what your risk profile is. And maybe you have the ability to go back like, Sachin Tendulkar out in the stadium. I don't know. There could be some prodigies out there watching. So my point is that know your context, figure out genuinely what you're able to do, use the law of inversion, which Charlie Munger talks about, very important. And do take a look at this memo, and please do leave comments if you feel like there are other memos which they want us to review, because this is very interesting to me and him. So we'd be happy to do more videos like this, and the company analysis videos are also coming soon.
Correct. So, like Shashwat said, do risk analysis. Don't do it every day. Don't do it every month. Once a year is more than plenty. Like your portfolio, going through, doing spring cleaning in your portfolio allocations. So, doing it once a year is plenty, unless there's a reason to do it any sooner. Assessing your risk once a year. Getting a most important thing in all this is making a plan, but the second half of the plan is sticking to it. Any plan is only as good as you following the plan. So make a yearly plan, your risk assessment, portfolio allocation, asset allocation, whatever you want to call it. Then get down to doing the hard work of putting it away every month or every week or every day, whichever way you like to invest, and make sure you hit those targets. If you don't calculate and hit those targets, you will not see the results you want, no matter how much risk assessment you do and asset allocation you do. If you don't finally, end of the day, put money where your mouth is, none of it is going to happen. So remember that. Anything else you want to add?
No, investing can be very satisfying and rewarding when we do it right.
Anyway, thanks for watching the video. Like Shashu said, I hope you had a wonderful time watching it. Do put in the comments what you feel and what you think of it. And based on that, we will try and react and take the content further down roads and avenues which you find informative and entertaining as always. Thanks for joining us today on Birich. We hope you have a wonderful evening. Bye.
Bye.